Okay, the first question is 3 stocks with very wide moats that you think will sustain in the next 20 years. When I read these questions, I'm thinking at 20 years, this is quite a long time because, there are many things can change within 20 years, right? So, and usually our investing journey the length of our investment is also, like talking about 20, 30, 40 years. So 20 years is more like the entire investing journey already. So I think maybe before we go into the details, right, I would just say maybe we don't have to, like tie ourselves to something for 20 years. Sometimes we need to, like keep reviewing our view and then make changes when necessary. I think let's say like a review on an annual basis, these are definitely helpful. But I do see that there are people who tend to, like review their portfolio and then make changes almost like on a monthly basis, buy, sell. Those are, to me, in my opinion, too frequent. Whereas if you keep to something for like 20 years, that's, to me, is like too long. Unless really you buy something like a S&P 500, something that is, like self-cleansing type of investments, right? Then it's fine. You can stick to it for like 10, 20, 30 years, not a problem. But if we are talking about individual companies, I would say you have to review them on a regular basis. Okay. But come back to this, which 3 stocks that I will mention here, right? So before we get to the companies, right, I will just say usually companies that can sustain for very long, they have some economic moats with it. So economic moats, right? This is a very specific term. If someone tell you that, okay, I invest in companies like Tesla because it's innovative. So innovative is a moat. Usually this is not really true because like it is not consistent with what's the meaning of economic moats. Economic moats, right? It tends to be something that's harder to replace. Technology isn't a moat because when you have better technology than your competitors, you don't know what are the stuff that your competitors are working on behind the scene, right? Like in other companies, right? You don't know. Like for example, like Nokia, at one point their technology is the best. That in terms of market share, they also took like most of the market share. But Apple is working on the iPhone, and then they are able to become even more popular because their technology become more superior, right? So technology isn't economic moats. But what are economic moats, right? Here I have listed 4. I look it up from the internet, but these are the common one. For those who have read about economic moats, they will heard about all this stuff. I'll briefly go through the meaning of these 4, so that just to give a brief idea. I think the first one, network effects. I think out of the 4, right, network effects is the strongest economic moats. The reason is because when you have network effects, you don't really need like a superior product or you don't really need a lot to actually maintain that. I think the typical example that people will give is like Facebook or Meta. When they have enough people get into the platforms, right? Even if a competitor come up with a better products, sometimes it's not that easy to replace them because people tend to be very inertial. They don't switch to another platform like easily. They tend to stick with that platform, right? So it's harder for you to get people to get to on board to another social network because they are on to Facebook or Instagram because their friends is already there. So the more people joining the network become more valuable and that attract even more people, right? That's why it's called the network effects. I think other business, say for example, like Amazon, they don't call it network effects, they call it flywheel effect, but essentially it's the same thing. It's like there's more customer get into Amazon website to buy stuff. And then because of more customer going to the website, more buyers who want to sell there. So all this, right, is like you just need to get enough people to on board on the platforms, and then you become like self-fulfilling, and more people will get into that platform. So this type of business or this type of power, right, is like even if you don't maintain much, it's very hard to displace. I guess that's also the reason why Elon Musk, he rather spend like tens of billions to buy Twitter instead, right? Because if you want to create another Twitter clone, right, isn't that hard, in terms of the software. But it's very hard to get people to leave Twitter and join his new social network. That's why when he spent billions to purchase. He's not purchased Twitter as in the software or the source code. He's actually purchasing the network effects, the entire, the members that's already on the platforms. So I think this is the strongest one. That's why if you look at the companies that I mentioned, I think most of them will have some sort of network effects. Then switching costs. Second one, this is also very powerful. Say, for example, companies that are using Microsoft, right? So I guess whichever companies that you join, you will likely using Microsoft software like Microsoft Word, Excel. So it's very hard to switch to another providers, because if you switch to another providers, the people who are not familiar with the other software, right, they are not able to be productive. So switching costs in terms of there are many costs. For example, if you switch to another providers, you need to do all the procurement, and then need to train your staff. All this is contribute to the cost. So companies usually, if they're happy with the services, right, even if the providers keep increasing the price, they will just continue to stick with it now. The reason is mainly because of this switching cost now. So other companies that have very high switching costs, for example, like Adobe, also fall into this. It's easier for companies to just pay Adobe and get the Photoshop, get the Premiere Pro, and let their workers work on it. It's easier that way as compared to they switch to another alternatives, even if the alternatives, right, is like providing software for free. So there are other costs that is not associated with the software cost, which is like the labor cost and training costs. And loss in productivities, right? So this is also a big one. The other two, I won't go into very details. Economy of scale, I guess this has something to do with cost. If you can produce something, and your cost is cheaper because you already have the scale, right? One example I can name is TSMC. So even if they charge a similar price, but they can still get much higher return as compared to their smaller competitors, because their scale is already very big. In terms of the foundry market shares, they are more than 50%, right? So all these economy of scale, it helps with the cost. And if your cost structure is lower than your competitors, it's very hard for your competitors to compete with you. The other one, the last one, intangible assets. I think this is something, like patents, which actually prevent your competitors from making the same products. And this is not permanent. This one usually there's some sort of a time period where you can just become a monopoly. I think this is quite common in healthcare, drug companies now. So and intangible assets. These are just a couple of examples. Definitely there are quite a number of other examples. If you are interested, I think you can just do some Google search on all these keywords, right? And then you can see examples of companies having all these economic moats. With that, I'll just go into the companies. I know the question is asking for 3, but anyway, I will give 4. And all these 4 companies are actually in my portfolio also. I'll go a little bit details on why I choose these 4 companies now, and how I link these 4 companies into the economic moats that I mentioned previously. So I think for Apple's, right, I know there are Apple fans out there. There are people who say, okay, I think Apple's good companies because their products are cool, or example like this, right? To me, whether the products is cool or not, that's not economic moats, because another companies can always come up with products that is cooler than Apple products. So that itself is not a moat. But if you try to understand Apple business model, and you will notice that actually iPhones or iPads, right? This is just a platform. People that bought all these devices, imagine that if they cannot install any apps on iPhone or iPads, right? Actually, the devices is almost useless. Even if you can have the best screen in the world, the device is useless without all the apps. And the apps, right? Although Apple, they can design their apps, and they can come up with a couple of cool apps, right? But it cannot match all the apps created by third party, all the software developers. So those software developers, I don't know what was the count. It could be millions of apps out there, right? So all these apps that form this entire ecosystem, this is the thing that actually become a huge moat for Apple. Because let's say, imagine that you have enough money to create another companies that is very similar to Apple. It's very hard for this new company to attract all these developers to be on board. It's very, very hard. Because again, back to the flywheel or network effects, right? Developers want to build apps on Apple or iOS ecosystem because the user is already there. They know that once they create this app, people will be there. People will actually download their apps and use it. And the other way is that people actually buy iPhone, or you can actually name put Android here. It doesn't matter. It's the same. And people buy iPhone is also because they want to access to all these apps, right? So these ecosystems, right? It took years to develop. Once it is there, right? I'll say the mobile computing, right? It will become like a duopoly between Android and iOS, and this is very strong. It's very hard to displace. That's why like companies like Meta, instead of like create their own device, sell their own phone, they focus on metaverse, VR, because they know that on the mobile computing platforms, they cannot displace Apple and Android. This is already oligopoly. But of course, on a newer platforms like VR, metaverse, where something is new, right, you can still compete because there's no dominant force on those like newer platforms. That's why it is like free for all. People can still compete with each other. Whereas for iOS smartphones, it's very hard to displace Apple and Android. And in PC, it's very hard to displace Microsoft, which is very dominant. So all this, like if we talk about like PC, Microsoft is not going to away. You talk about smartphone, Apple, Android is not going to go away. And when you talk about e-commerce, like Amazon is not going to go away. These companies, right, they will last for years and years, just because of the network effects. So to answer that questions, I'll say these four are my favorites. Of course, the list can be very long, and this is not a binary, right? When we talk about economic moats, it's not like 0 or 1. You have it, you don't have it. It's not like that. It's more like, okay, how strong is your moat? Because even if you have some sort of moat, sometimes if it is not a strong one, yet people can still like come and disrupt you by coming up with a better products. I don't know. I think I'll give maybe just one example. Like if you talk about e-commerce in China, I would say Alibaba is still very, very strong. Doesn't mean that they will be there forever. It's just that how strong are they and how much can they monetize their platforms also depends on the competitors, right? So say, for example, like JD in China and Pinduoduo in China, they are trying to compete as much as possible. And in terms of their services, I don't think JD services is bad, right? So that's why there's always competition, and the competitions will be there to, prevent you from monetizing too much. So I think all this is like, depending on how strong is the moat, and then you can see that how much they can monetize that. If it is like super strong, right? Then all these companies, they can monetize like mad, and still people cannot do much about it. Yep. So I would say this lengthy answer for this first question, but I think it's worth the time to give some more extra background on these questions. Okay, who else is here? Okay, I think YCX is here. YCX, you have anything you want to add on talking about this first question just now? Which companies that you think will be there for the next 20 years?
No, I think every company has a chance of dying.
Yeah, I remember you shared, right? You said, like companies like Nokia, Kodak, all these companies can be huge during the time, right? But all companies will die, but some companies die faster because lack of moat, but some companies can last longer because of the moats. That's my point. But I do agree with you, like we shouldn't treat like companies as like they are immortal, right? All companies will die, definitely. It's just that how easy it is now. And I can bring up one examples, right? I think this is because the question was asking about 20 years, right? So we just need to go back to like 20 years ago, which is 2003, and look at like the largest companies back then, right? So I think Microsoft was there because back then we still don't have much like all these mobile platforms, right? So of course we are talking about PC, and PC Microsoft was big back then. But other than Microsoft, you can look at other companies like General Electric, GE, companies like IBM. They were huge back then, but where where are they now, right? So you can even look at some of the trend. For example, I think I pull out IBM. So you can see that 2003, they're still like growing companies, and then they continue to grow for until 2013, and then something wrong, right? Because I think in terms of their business, if they're not able to stay at the forefront of the technology, you can see that they actually struggled. This is net income. This is not revenue. But you can see that when they start to struggle, right, they just fade away and just die out. So I think that's the natural evolution. There's always new companies that replace all these old companies. It's just that the replacement, whether it's hard or easy, it really depends on all the like the business model, whether the moat is strong or not. That's why I say when you look at individual companies, you have to review it constantly. I bet that even for NVIDIA, Y6, you also have to review it regularly. Right? Maybe not every week, but something like every year things will change, especially in AI space. It's still new space, right?
Yeah, correct.
Okay, that's first questions. Let's go to the second questions. If traders are rich, why do they sell courses? Interesting questions. I don't know which traders that I mean, whoever posts these questions, right? Which traders are you referring to? Maybe anyone here can help out, like can give a couple examples, like on this. Is it like people like Adam Khoo or who are they referring to? Anyone want to give some context? Because I'm a bit how to say don't know how to picture on these questions but it's okay. Let me try. Maybe let me guess I guess the person who asked these questions are looking at probably like YouTubers, traders, like they sell course. They give something free on YouTube and then they sell you course, right? And the course are really like those trading courses, right? I'll say, I mean, general thought on this is that, when it comes to trading, right? I think those who know how to trade, they will know. Even for the most successful traders, right? You can't, consistently win money. They are trying to look for, like trading strategy that when you win money, you win huge money. When you lose money, you lose a little bit. That's why on a trading strategy, right? I think there's this very important concept called stop loss, right? You always bet on like, okay, if it go against you, then you don't back hold. You just stop loss and just do it again. So out of 10 trades, they could lose money 6 or 7 times, it doesn't matter. But when they bet on something and they get it correct, right, then they will just ride on it as much as possible. And once right until it turn, and then they will just close for profits now. So the goal is not to make money constantly. The goal is to make big monies and lose small monies. I think that's the most common trading strategies now. And why they want to sell course is, I mean, the fact is that when they sell course, right, the profit that they take from selling courses, this is like sure win, like 100% out of 100, 100 out of 100, they win money. So imagine they have two sources of income, right? One is like, okay, they lose small money, lose small money, and then win big monies. The other part, which is selling course, is like keep winning 100% of the time, right? I will say that one is just like the perfect setup for all these traders, right? So at the same time, they have money coming in, and then once a while, then when they write on something big, they win big monies, and they can share how they win the big money onto their course and attract even more students, right? So to me, those who know how to sell course, who know how to trade, it's like the entire setup is just like perfect for them, but you need to understand that they really profit a lot from selling costs than their own trading, unless they have a very, very big portfolio and they really like super top when it comes to trading. I actually doubt, to me, I would say they are good traders. There are brilliant traders out there. It's just that out of 10 people who claim they are good traders, how many of them actually like super good, right? That one I have very I'm very, very skeptical, unless someone who can say they do, like Twitch live trading every day, and there's a very clear track record on how they make money consistently for years and years, right? Then to me, okay, that's something to prove. I would say many people they just hide their losses and they just show their win and then attract people to buy their course, and actually they make money selling course, and you have no way to know all the details because every course sellers out there, if they want to hide things from you, they can because you just can't know everything, right? They can just hide things, right? So to me, there's the only way to validate their trades is really like they do live trades all the time and you follow their trades all the time and you really follow their trades and you win money. To me, that's enough of a validation. If not, they're just selling costs and you are just paying them and they get rich and you don't get to. So that's my view on this. I'm not saying that trading, everyone trade is like losing money. To me, that's not my opinion. I'm just saying that most people, they, when they win money, they share. When they lose money, they just keep quiet. You don't know whether they are good or not until all these validations. So that's my take on this. Anything to add from others, YCX or others? All right. Thoughts on Ray Dalio course. Should I buy? Many people defending him because he don't need the money, but feels like double standard to other course sellers. This one I would say, actually when this course come out, right, I would just say this is not like Ray Dalio, acting like an individual course seller and just want to make money from you, right? I think the class is master class. So if you go to the website, right, I think you will see that it's not just Ray Dalio. There are many other, like the big names in their field, right? That should this like a documentary I don't think it's like a course selling course, right? It feels to me like a documentary than like an interview. So I think this is not really Ray Dalio selling. This is mostly the masterclass selling the course, and they sell the course or they sell the access to this material because they are the one that spend the effort to shoot the recording. All this actually there's production costs, right? So they are making, this is their business. Basically they just sell this and they spend money on the production, right? So you can see it's not just Ray Dalio. There are many other guests on the show. And talking about like defending him, I'll just say maybe you just treat it like a movie. There's production costs, and if you want to watch the things, then you just pay and you go and watch. Whether it's helpful or not, I don't know because I don't have access to the course. But if you are interested with Ray Dalio, actually you don't need to subscribe to this masterclass. You just go YouTube and you just type Ray Dalio. There are plenty of long form interviews that you can just watch, right? And to me, if I think it's like equally good, or those long form interview, right? So you can just watch Ray Dalio interview and you can learn, right? And there's free resources, including the ebook that's shared on the Telegram group, right? For those who are interested, there's like 100 pages of book that you can read. And I'm sure when Ray Dalio he wrote the book, I think he wrote everything that he want to share there already. The question is, do you have the time and patience to go and read out and try to understand his point of view? Because he's really focusing on all these macro topics, right? Macro topics is not like useless or what. It's just like when you study macro and you study individual companies, these are very, very different domain, right? And if you want to understand macro, you cannot just understand the theory. You definitely have to go back to the history. And I think Ray Dalio really did a good job that went back to don't know how many hundreds years of all this historical cycle and try to like come up with something that he thinks helpful for you to understand what is going on with the economy right now. So all these I think are like good materials. If you have time, definitely worth the time to go and read out all these, watch his interview. About these courses, I think it's not needed. That's my view. Just because someone sell the course doesn't mean you should buy. If you go and buy every course, I'm sure you are the first one to go bankrupt also, right? Some of the course is like super expensive. I would just say today, all these resources, they are all over the internet, right? Go to Twitter and just connect with people. You get all sorts of free resources. And all these free resources is not like they are bad, they are great resources. The trick is whether you are able to find them or not. So sometimes you need like like a community so that people share things and people share good stuff, right? It's not like we share everything, right? So just follow all this trail, you can get a lot of like good resources. I think the bottleneck is not about like how much resources that's available for free. The bottleneck is always the constraint or the limit that we can go is always our time and our energy, because all of us only have like 24 hours. We don't have time to go to every all these resources. That's the things that you should worry about, and not to worry about this specific cost. So that's my take on this. YCX, anyone you want to share on your view on this?
Just read Wall Street Bets. I think Wall Street Bets is a good resource.
Yeah, I think definitely. Reddit also good resources. Wall Street Bets also good resources. Twitter. I think these three alone is like, I mean, these are like this is just the how to say, the surface, right? Because from one tweet can lead you to another Reddit, from one Reddit can lead you to another link, then you go to all over the internet, right? I think this is definitely a good place to go. I mean, this is just a course. Yeah.
I think fundamentally for all these causes, it's important to separate into two different things. One is about trying to get alpha. So if you're trying to get alpha, then this one is really dependent on your own preference on like, because even if someone tell you some piece of alpha, it's up to you to judge and do your own research. You don't just trust every alpha on the internet or anywhere else. So what I mean by alpha means that somebody tells you, like, say, hey, stock X is going to go up 2 times in the next 1 year, buy it now, that kind of idea. So that is alpha. And all kinds of people are saying all kinds of things on the internet, like buy this or sell that or whatever thing it is. It's just that there is that that is more of like the research kind of things. Then the other kind of things is like the techniques, not the alpha, but the techniques, which is that if you, let's say you understand some particular stock or some particular market is going to stagnate or going to rise up very quickly or going to go down or whatever it is in the next, 6 months, 1 year kind of things, right? Then you want to kind of like capitalize on it and you want to know how to capitalize on it, then that will really depend on your techniques. And then for techniques wise, it's basically just knowing like how to get leverage. The fundamental idea is how to make your money represent more money, which is leverage. Basically, that's what it means. That means like instead of betting $1, you're actually betting $5. But if you lose 20 cents, then your $1 is gone. That kind of idea this is this kind of things. Also, if you're there to learn techniques, if you're there to learn techniques, then it just depends on whether you are whether like the teacher's style of teaching clicks with you or not. If you're there to learn alpha, then that thing is entirely different. So you have to split out into these two very clearly. What is alpha and what is technique?
Yeah, I would say that for those who do like this kind of alpha short term, like less than 1 year count big trades, right? I think the technique will play a much bigger role, because there are people who bet the direction correctly, but because of the technique they got it wrong or they are unlucky. You stop out before the things rally, right? So you don't get to participate, right? These kind of situations, I think the executions is a lot more important when it comes to trading. But when it comes to really like longer, like those unlevered kind of like long-term investing, I would say if you get the companies correct, you just stick with them for a long period of time. The executions isn't that important because let's say if you even bought it at 10-20% higher compared to like maybe 3 months ago, but still after like long period of time, after it compounds to 2 or 3x, you still can but like get a very decent return out of it. So I do agree with you. Depends on what each of you looking for. Like what's your style? Are you actually like do a longer term or is it like like a big trades but on a shorter term trading kind of things lah. So definitely these are the things to learn, and there are different places for you to learn. I think for technique wise, I would say those who do live trading, like YouTube, I think these are definitely place to go lah. For those who prefer books, I'm sure there are books out there as well lah. But I think
I think the other thing is also that if you keep listening to all these calls, right, but then you don't use or you don't do yourself, then you also won't remember or know how to react to these kind of things. Because let's say Ray Dalio is I mean, from what I understand, from what I listen and read of his things, right? He is like a kind of like a macro, more geopolitical and macro kind of focus, which is why you can see from his investments as well. He had, like last year, he had been shorting the European markets, and then like, so you can kind of see like each of these investors, they all have their own like their own field of expertise. So Dalio focuses on that area. You look at someone else, like there's many different kinds of styles out there. It's just that if you go there and you learn about his things, but there's no way for you to apply it because Dalio himself he's running Bridgewater Associates, and the access, the kind of access to the products that he can trade, right, is way more than the average retail investor. Like he can do things like shorting products or whatever that you don't even know and don't even have access to. So how he balances his portfolio and everything is completely different. So you can kind of get from his understanding is that how he thinks the macro will turn out. But then that is like over like 5-10 years kind of things. Do you really have that kind of 5-10 years to learn his style of doing? Probably it'll be better if you can just get a job in his industry or something and do that lah. But if you are trying to trade based on him, number one, your product list is not his product list. Then number two is because of his status and his understanding, right? He has more resources than you. He can straight away see, and he have first party information. That means he has, I won't call it insider lah, but he has first hand information before other people, right? On like how a certain market is going. So from that perspective alone, if you try to model after him, you need to have the same kind of resources that he has to do exactly what he does, which only happens if you are working in the industry and having that kind of resources. But if you're not, you're trying to copy him, then it's going to be quite a challenge unless you read him properly. But even then, as you know, he can change his mind based on like how maybe Europe suddenly come out with some new policy today that entirely changes things or whatever.
Yep, definitely. He's the Bridgewater Associates. This is the largest hedge funds, right? So when it comes to resources, no one can beat them. So and even the stuff that he said, right, doesn't represent the actual investment done by Bridgewater Associate, because I recall he mentioned that he said you don't invest based on like one idea, right? You actually need at least like 10 uncorrelated source of alpha. Like you trade on different things, you bet on different things, like 10 different things. These are uncorrelated. Each of them, you think that there's some sort of alpha in there that you make a position, and even if you don't get it right on 10 out of 10, even if you just get 7 out of 10, I think it's still like they can get a very decent return out of that. And all these insights, right, or the 10 different positions that they bet on, even the Ray Dalio himself, he probably don't know about it because he don't run the hedge funds that actively anymore. It's really run by his team, right? And people down there, the portfolio managers, they do their things, right? So I do think that the stuff that he shared is useful. It's more on the macro side of things, but don't expect that when you listen to his interview, 20 hours, 100 hours of his interview, then you can achieve similar similar kind of results that Bridgewater Associate achieved. So that shouldn't be the expectations now. Okay, I think enough on these questions. Let's go to the next one. One stock in your portfolio that you will believe and hold in the next 20 years without looking at the news. I'm reading the last line here, without looking at the news. Right? To me, like I said earlier, right, I don't think there's any company that you can just stick with it without looking at the news for 20 years. The reason is because 20 years is very long time. Anything can change, especially now the pace of change is actually increasing. The only thing that I would say that I'm okay to hold on for 20 years without reading the news is really just the passive type of ETF like S&P 500 or like VT ETF, right? These are like, I'm happy to bet on one asset class, equity asset class, without looking at the news for 20 years. But talking about one stock, I would say it's very dangerous to do it that way. I can't name any because 20 years later, I think all of us will be surprised, like which are the top 20 companies on the stock market after 20 years. We can't even see past next 5 years, let alone 20 years, right? So I will refrain myself from giving one company's name here. But if you are interested with which companies have moat based on today's view, right? I've shared about it in the earlier sections now. Anyone want to share on this your comment or your view on this on these questions here?
Freehold property in Singapore or in Texas or Florida. I think that's about it.
Freehold property. Okay. Freehold property. Property is not stock. I think Chicken mentioned, Chicken, you can unmute one if you are able to. He said Berkshire Hathaway. I don't think I think Warren Buffett probably he will still be managing the portfolio and Berkshire for another maybe 5 to 10 years. 20 years, I would say a bit stretched for him. So, but the companies will be there. I won't be surprised that, like Berkshire still standing 20 years later, right? The question is, can they, for example, right, can they actually beat S&P 500 or not? Because it really depends on whether the investors still have trust over the next generations of the manager, right? So this one, I would say, once he passed the company to the next CEO, actually he can't just take it for granted, right? He have to build the trust, have to do proper capital allocation. I think the culture will stick, but whether you can just without looking at the news and just say that this company you just hold for 20 years. Especially a company like Berkshire, where people trust the company because of Warren Buffett. When he's not around, will you trust the next generation manager? I think even if I say the culture will stay, but you don't know about other investors, right? When other people see, let's say the manager's quality is not as good as Buffett, and they start selling, and the share price doesn't perform well, are you able to just backhold the companies and thinking that Berkshire will stay as Berkshire forever? I think I'll have some doubt given that it is 20 years thing. If it is 3 to 5 years, I would say the business won't change that much. The culture will stay intact. Manager probably also won't change that much within 3 to 5 years. But 20 years is very, very long period of time. You see even some country, let's say UK, right? I don't know in 20 years time how many prime minister they have already, right? So I'll just say this is like very long period of time. Anyone want to comment on this?
I think usually what will happen is that because 20 years is very high variance, right? Then what will happen is usually, if let's say the kind of things that will make people like disagree on the direction of this type of large popular funds is when there's some kind of regime change, really some kind of regime change. And then if your manager at that time is not really like that proven, right? Then there will be disagreements on whether the direction that the manager take is the right direction. And definitely, if let's say there's no regime change, you won't have this kind of question on. But the moment there's regime change, there'll be people questioning. Some will be like more fundamentalist, or that means like say this isn't according to the whatever the teachings of Warren Buffett and whoever. Then some will be like, actually it's a new time, we should follow more according to like the times change and we need to change, and this guy is a new exceptional manager, we should give him the chance, that kind of thing. Then you will kind of see this kind of dynamic, and then that's when people either pull out their money or they put in and then go along with the regime change or whatever things. I mean, obviously I can't tell you like what the regime change will be about, because this kind of things is come from all kinds of direction one. But every time there is like this kind of things, this is the kind of outcomes that will come into play. There are people who fall to two sides, and you have to choose one side. And ultimately is about you yourself and how you decide whether you want to go on with the new or you want to stay on with the old principles or that kind of things. Yeah. You can kind of also see in like how fast like crypto projects move along, because as you know, crypto projects is kind of like speed run on everything, right? You can see that even for a lot of those crypto coins, they have like the moment they start, then like within 1 year, there's got like some kind of new branch out project. Someone has a different vision or whatever thing, because they can just change the code very fast. They just launch their own and call it a different name and say that we follow according to this or that. It happens very quickly. It's just that on the scale of like these multinational institutions, right? They happen much more slowly. Yeah.
Yep. Thanks for the comment. Nothing more to add on that. But the next questions definitely I need to get your view, YCX. From Martin, welcome back. What is your view on the surge of tech stocks due to AI hype, and can AI have a significant breakthrough in your opinion in 5 years' time?
There's so many different areas that AI can touch upon. So I think it is already doing significant breakthroughs now, because you can kind of see that how much time you save when you just use ChatGPT. Just ChatGPT's basic function, which is like forming templates and idea generation, right? And you can kind of see that it already does a lot over there already. So of course, right now it's still based on like it's still based on the one-shot prompt, which is that you must know what to type to it, and then you get some kind of answer out of it. Then probably the next breakthrough will be that it doesn't need that one-shot prompt kind of thing, which is that it just generate information. You just give it like a vague objective, and it somehow generates like detailed or specific advice from that vague objective. Yeah. So right now is you give it right now is like the prompt, the one-shot prompt, which is that you give it the more specific you give it, the more tailored the answer is to whatever you give up. Whether or not it's true or hallucinated or correct is another thing, but at least you'll get some kind of output out of it that is relevant to your whatever you're asking. It's up to you to check. Yeah. But the next step for this kind of large language model is just that, like you give it a vague objective, like say make toothpicks. Like you say, how do I make toothpicks? Then it just tell you like, okay, to make toothpicks, then maybe it might even ask you questions back, like say, are you trying to open a toothpick factory? Where do you want to open it in? That kind of thing. But now it's like they'll just give you a very vague answer. You make toothpicks by taking wood and then by making it, that kind of answer. So that would be the significant breakthrough for large language models. But let's say we are talking about AI. AI has a lot of other things, which is not just large language model. You can just take a look at NVIDIA's area of researchers. Then you can kind of see that there is many areas here, which like one of the more one of the more easier ones to understand is drug discovery. So like drug discovery, the traditional way of doing it is that you have all these people and then they test all these different kind of chemicals, they synthesize it and then they test it one by one. And then based on like whatever research notes that they already have, they can kind of like think through certain drug has going to have certain effects, and then they test on live subjects and then verify that the effects and things. So this is all very time consuming, and there's a lot of approval steps to go through, and because it's physical and laborious, right, it takes a lot of effort. But once you have things in computer simulations, and because the computers, if you have it right, that means you program it properly, you can simulate the physics of it, you can simulate the chemistry of it, then you can kind of like speed up on all these simulations and generate out more drug discovery possibilities over here. So that's also AI. You kind of look at it. So I wouldn't say it's more of like there will be significant breakthroughs over the next 5 years, but the breakthroughs will happen in this kind of piecemeal ways that you won't find it to be a breakthrough, that you think that it is like a natural progression and it just happens over time. Because you think about it, it's just like, did you find that the iPhone is a breakthrough from like when the iPhone came out in 2009 or something, right? I can't remember the exact date. People just thought that it was another phone and it has all these things, and people compared like the old phones and the new phones, what apps they have, what they can do, that kind of thing. So then over time, you kind of see like the smartphone has the way of scaling up, and then like people's entire life start to revolve around their smartphones. Some people don't even need to use their computers. They just use their phones to do their things. And it was like a natural progression. You don't find it to be a significant breakthrough. But then if you were to tell people in 2008 like that, or 2009, that we are going to have this new product, in 5 years time, you're not going to use your PC anymore and you're just going to use this product to do everything, then it will look like a significant breakthrough when someone tells you that. But when you go through the process, it doesn't feel significant at all. It just feels like a natural progression because you bought like the first iPhone, then you bought like, maybe you skip one generation, and third, fourth year, you bought another iPhone. And then by the 6th year, you start to naturally use this type. You don't call anymore. You don't even SMS anymore. You start to use WhatsApp or things. And then you start to have all these Instagram and things, and it just takes over. Yeah. You know, you won't feel the significant breakthrough, but when it comes, when you look back 5 years later, right, you kind of think, wow, my life has changed so drastically because my entire way of working is entirely different.
Yeah, definitely. I think that's the way forward. It's just that now, because of the ChatGPT, before it came out and after it came out, right? People feel that there's this like a big step up. Although before this, I mean all this GPT, when it came out, it's GPT-3, but before that, there's already GPT-1 and 2, right? And definitely there are people who are working on that, but you don't feel the breakthrough. But suddenly you have a GPT-3 moment, and people will tend to think that, now suddenly AI is here. Before this, it's not here. But actually, AI has been around for long period of time now. Say, for example, like I think when it comes to Meta or like Google, when they do their ranking, all this also is some sort of like artificial intelligence involved in there. The recommendation engine, which I think back end still they are using a lot of all this NVIDIA data center chip also, right? So all this is like they have been there for some time. It's just the large language model. This is relatively new and it become very popular within short period of time. So all this definitely sounds or feels like a breakthrough, but I do agree with YCX is that moving forward, you see that more and more, how to say, adoptions of all these large language model in all sorts of places. I think the first place that it will go to is like all the, like customer facing type of environment. For example, like when you have some problem with your trading and you want to chat with your brokers, what happened with my margin and so on. So instead of like a real person replying you in message, it will be some sort of all this ChatGPT kind of API or AI bot that speak to you. I think this is the first place that they will go, but that's like immediate one. Then later on, there will be more and more adoptions. Say, for example, tuition center, do we really still need teacher or not? Or can we have an AI bot that actually can understand student questions and they can take over like huge proportions of the entire tuitions business, right? So these are also like, we'll call it more like adoptions rather than breakthrough. So it's more like finding different use cases using the large language model. But come back to this question is like, okay, if we are not talking about like just the AI adoptions or AI breakthrough, right? We want to look at what the search of the tech stocks, right? Because we know that companies like, NVIDIA went up a lot. TSMC also went up quite a bit. Then other companies, maybe Microsoft also, I mean, we've seen the stock market has been quite green recently because of the AI hypes, right? I'll say whether all these companies, they can sustain this kind of rally in the future, I think it still need to be backed up by the fundamentals. Say, for example, like I think the best one is NVIDIA. If you look at their current revenues, net income, operating profit, all these figures, because if you look at the latest quarter numbers, you're actually looking at the past, right? Meaning that the latest one is, I think, Q1, right? So if you look at the Q1 numbers, yes, they already sold some of all these data center chip to their customer, and there's already some revenue that flow in, and they guided a much higher revenue in Q2. So we see that there's definitely huge demand in this space. But looking at their valuation, you still need to judge whether, okay, we're talking about like 5 years time, how big is this market? How much money that will be spent by other customers? Say, for example, like Meta, they want to do their metaverse, they want to use large language model to do all sorts of things, right? They need a lot of all these data center chip. How much are they going to procure from NVIDIA? Is there any competitors or not? So I think all these questions, right? Because ultimately you still need all this revenue that come in, that flow into operating profits to justify the valuations. How big is going to become? I don't think it's simple questions. It's not that easy to answer these questions because it's a very new market. We don't know how big it's going to be. Say, for example, like Adobe also have their Firefly software. And I'm sure all these tools are very useful for the users. Instead of like spend hours and hours to do their work, now they can just, use some prompt and then they can achieve the result in short period of time, and that actually save a lot of labor costs, right? So all this, there's enough reason for these companies to offer these services to the customer and charge money, and customer will definitely pay. And with that, they can take the money and spend more into all this chip. Some revenue definitely will flow to companies like NVIDIA, and look at the entire AI value chain. NVIDIA is the one that design chips, right? Behind the scenes, you have TSMC that's manufacturing the chips. So this entire value chain is not like just two companies. There are many other companies involved. You just need to see like how big is the market, how much each of these companies are able to capture, and then from there, what kind of margin that they can command. Margins also depends on the competitions, right? So need to piece together all these different pieces to come up with like, okay, what's the valuation that makes sense to you? I'll just say, like when let's say including YCX and myself, right, both of us invest in NVIDIA. But I think even we invest in these companies because we understand what they are doing. We understand where they are strong at. We understand that when it comes to competitions, why it is hard for other competitors to come and disrupt them. So these things we can qualitatively judge it. But if you ask me to come up with a numbers, say how big is the market, I would say it's very, very difficult to come up with this kind of numbers. That's why for companies like NVIDIA, it's very hard when it comes to the, valuation numbers that actually make sense. because I think when it comes to growth investing, I would say sometimes there's more towards the narrative side, towards the qualitative side as compared to the quantitative side. So this one you need to be aware of that now. So yeah, come back to these questions again. Like I think we answered two different things. One is like what's the path, the adoption path, and whether we foresee significant breakthrough. The second part is like, given that this entire large language model AI things going to proceed, going to evolve in the next 5 to 10 years, right? Which companies will actually benefit, and how to view the valuations, that does it make sense or not? I think I give some directions, but I would just say that it's very difficult to judge us. I'm sure that there are people who still think that this field will be, like 10, 100x larger as compared to today. Hence, even NVIDIA, you look at their PE 200, they still think that it is cheap, right? I can understand this kind of view. At the same time, I also can understand people who just stay away from it because they say that this entire thing is just a hype and no way they're going to spend 200 PE to buy into NVIDIA. Everything is just story, narrative. They don't want to bet on. I can also understand on that. So it depends on where's your position and depends on your view with regards to this field and the entire markets. Okay, I think it's very lengthy answer on this again. Anyone else you want to contribute? I saw quite a number of other names. For example, Ikin Nico is here. Top Investing is here. Maximus is here. You want to contribute or you want to comment on this question? Okay, if not, let's proceed. What do you think with Apple shrinking equity in balance sheet? I think due to buybacks, is it a bad sign or what? Yeah, I think this one is a simple one. Yes, the answer is due to buyback. So I think I have put up something. So if you look at their total shareholder equities, so for those who are not familiar with stockholder equity, this is actually just looking at the company's balance sheets, right? You look at the total assets, then you just minus the total liabilities, then you get the total shareholder equities. And indeed, you can see that it peaks at 2017, and then from there, every year it's like drop, right? So yes, the stockholder equities is dropping. And yes, the answer is really the stock repurchase. So I think this is, what's the name? Icahn, right? Carl Icahn is the one that pushed Apple towards share buyback because I think let's say before 2017, when it comes to their business, they're still, I think they are not confident in terms of their income statement or the health of the business. So they have been accumulating quite a fair bit of surplus on the balance sheets. And then this Carl Icahn, he stepped in and he said that, okay, Apple, they really need to do something about it. They cannot just keep on accumulating cash into the business. And that means the capital is not used efficiently. So he pushed for the share buyback. So that's why I think Apple also, they issue bonds, right? Because they don't want to take their cash, because some of this cash actually is not sitting in US. They are sitting in balance sheets outside of US. So if they take the money back into US, I think there's some tax implications. So what happened is that they just issue some bonds and take the money, and with their operating profits and net income. So they've been conducting a fair bit of share buyback in the past, past 5 years. So you can see this is the chart showing that all the common stock repurchase, right? You see every year they spend like what's 90, 80, 70, 60 billion kind of money on share buyback. As they do the share buyback, right? Of course, the stockholder equity would drop now. So yes, to answer that questions, I would say like almost all the drop in the shareholder equities is really due to the share buyback. So that's the thing. The second question was asking like, is it something like that's bad, right? So I would say it's not bad. What it means is just that now companies hold lesser surplus within the company. Of course, let's say if everything just status quo, right? Imagine that the revenue just grow at single digit, profit margins stay quite stable. all this share buyback is actually fine. It's like they don't really need all this money. These are excess money on the balance sheet, right? So they take the money and just return to the shareholders. You can do it via dividend. You can do it using share buyback. It's just that dividend, there's withholding tax. That's why it's not the preferred approach. But essentially, it's just like saying that companies earn money. They just return all this money to the shareholder. And from the balance sheet perspective, you can see that there's a drop in shareholder equity. Those are fine. Those are okay. With the caveat that everything stay as status quo. Because imagine that if something wrong, I say, for example, like they have a huge competitions coming from another companies and they have to spend capex or in order to compete, to stay, to hold the market share, they cannot sell iPhone at current margin. They need to drop their margin, or they need to get into a new line of business just to secure certain things, right? For example, they need to spend huge money. If they don't have a lot of all this surplus sitting on the balance sheet, that means how much they can navigate, how much they can do to navigate all these difficult environment or difficult situation. There will be lesser flexibilities. So this is something to pay attention to, is that of course, when times are good, they can do share buyback. The question is when times are bad, right? With now, after the share buyback, they have less resources. Can they navigate out of it? So the less money they have, that means the lesser flexibility they have. So this is like a cost that they are paying, and we can't see it because up until now, you can see that their margin is quite stable. They don't really need all this money. It's just that the question is more like during tough time, how tough is it going to be for Apple? If those tough time is getting very, very tough, of course, I would prefer them to keep some money for themselves so that it's easier to navigate. So that's my view. But for now, I would say that they still have plenty of money on their balance sheets. So I would say don't have to worry too much for now. If you can contrast this to Tesla situation, there's a period of time when all the Twitter sphere, you see that people who say, Tesla is making money, they should do share buyback and so on. I would say Tesla is at totally different stage as compared to Apple. First, they don't have a lot of cash. Secondly, yes, they made good amount of profits, but that was last year, and you can see that after they cut the price of their cars, their gross margin drop, their net margin drop, their free cash flow drop. You can see that they are not making a lot of money, and still they have to open all these big gigafactories, and they still have to spend money on capex and so on. So I would say that companies like Tesla, they can't do share buyback because they need the money to cushion the bad times. They need the money for the capex. For Apple, it's totally different. This is like big cash cow, right? If you look at their revenue, it's close to 400 billions. 1 year, they earn 100 billions, more than 100 billions. If they earn 100 billions and they spend 80 billions on share buyback, they have 20 billion left, right? Which add to their balance sheets, right? Still, it is like increase in amount of cash that they have, right? So, I would say that for Apple, it's not a concern. Okay. Again, okay, I think I've answered these questions. Anyone else you want to comment? Let's go to the next one. How about the companies like Starbucks, McDonald that have negative equity? Why they have negative equity, and is it bad sign for the company? Okay. Again, good questions. I don't have good answer for this. To me, right? This entire equity thing, right? The negative equity or positive equity is a balance sheet view of the company. And to understand the companies, just looking at the balance sheet alone, right, is not enough. You have to look at the entire picture. You need to look at the income statement. You need to look at the cash flow statement. These three are the basic. Okay. You need to look at three together, and you need to have some sense of their business model. And you need to have a sense of, when you look at their balance sheets, how are those assets being valued? So there are quite a number of things already. Okay. So yes, I did look at the numbers. Do we have the screenshot? Sorry, I don't have the screenshot here. But yes, if you look at the screenshot, just go to roic.ai, right? You can look at the negative equity of McDonald. What it means is just that their assets is actually lesser than their liabilities. But is that a problem or not? I would just say negative equity doesn't mean it is a problem. Because imagine, right? Let's say I create a new company now, okay? And this company, I just throw in like let's say 100,000 or 10,000. Don't have to be 100,000, 10,000. So I throw in 10,000 and then just do some coding. I sell these services, and every year I earn 1 million. Okay, so every year I earn 1 million. If I can convince a bank to give me a loan, okay, say, you see, I have strong earning capacity. This business is very stable. I have contract with my customer. They are going to pay me 1 million every year. Please lend me $1 million. Bank, if they understand my business, they look at the contract, they think that, okay, because I earn 1 million every year, I have zero cost. To lend me 1 million is not a problem. They can just lend me 1 million, right? So I took the 1 million and I spent on all sorts of things as expenses, right? Just expense out. In that scenario, right? If you look at my balance sheet, it's like, okay, I spent all the money. I have a debt of like 1 million from the banks. If you look at the balance sheet, it's negative, right? Okay, because I have debt, I don't have assets. But is that means that I'm in problem? It's not, right? Because I still have good earnings, and just 1 year of earnings, I can just pay back all my debt with the bank already. So that's why I say, if you just look at the balance sheet, it's a balance sheet view. Doesn't mean that the company is in trouble. Because if their income statement is good enough, I think the negative equity, it will become positive again, right? So it's not a problem, sir. Again, you still need to look at how the assets is being valued, because, say for example, sometimes the assets are not valued at market value, right? It could be some assets that's valued at, like historical cost or something like that. So it will be understated. That's also can contribute to negative equity. That could be one reason also. So there are all sorts of reasons, but I think if you look at the balance sheet, you look at the income statement, you can have a rough view of the business. And you can have a rough view on whether the business is healthy or not. Just one number alone doesn't mean a thing. So I'll just stop here. So this one is harder to give a lot of like detailed answer. We have to go into the McDonald's like their income statement, balance sheet, and to understand how can they stay at negative equity and still be fine, right? So I can't judge too much by looking into the balance sheet in detail, but I just can conclude that this negative equity alone is not a problem. You need to piece together different information. Okay, that's my questions on this. What do you think of LVMH or RMS? Great mode for luxury goods sector, inflation-proof business. This one, I think maybe you can reach out to others who actually invest in like all these luxury companies. I recall there are quite a number of people who invested. I myself, I'm not expert in like all this, like, luxury. I don't even know Charles and Keith is luxury or not when that, like TikTok came out. so that's my understanding on, like, the luxury market. But my view on LVMH, right, is this picture here. You shouldn't treat LVMH like a single business. They are more like an ETF. Like an ETF that actually have ownership into like hundreds of different brands. Like all those brands could be, like wines and spirits, fashion and leather goods, and then they have like all the watches, handbag, all this, like, even Charles and Keith also, they have some stake in it. So it's like more like a ETF of luxury market. Yes, if you ask me about like in terms of their pricing power, I would say yes, they have pricing power. Whether their valuations make sense today, I can't judge. I look at their PE compared to historical period. I mean, this is the picture, right? Looks reasonable to me. Doesn't look cheap, doesn't look expensive. So if you want to get some exposure, for example, like if you ask me whether I will buy a LV bag for investment or just buy the stock, I will definitely go for the stocks. So that's my view. But whether it will be a great investment or not, I don't have much insight here. Anyone else want to comment on this?
Sorry, then what's your view of founder or family-owned type of business like for LVMH, right? My understanding is that he brought in his family members to run the business as well. So do you see that as it's like a dynasty. So is that a good or bad thing in your view?
I think very hard to judge because definitely we have those dynasty type of business that is doing well for a couple of generations, right? There are like good examples of this kind of business, because imagine that the second like let's say those who the son of the founder, they are taking over the business, and the learnings, right, is not just via like the professional setup and learn how to do business. It's even at home also. There's all this like teaching from the parents, and they get the entire package, right, from home, from office. They learn all these things. So to me, that's the good things, and definitely there are good examples of this type of business where founder led, and then the sons of founder led business driving. I think this is definitely, there are good examples. At the same time, right, there's also business where the son or the children, they fight with each other, and then they don't really know how to manage the business. They inherit business because that's their the business from the dad, and not really because they are good at managing the business, right? So there's also like bad examples. So I would say it's very hard to generalize whether this type of situation, family business type of situation, whether good or bad. Hard to judge. I would just say we can't skip the due diligence, in the sense of we still need to see, like, as the new generation or take over the business, right? Or if the founder, they step down already, they pass the business to a professionally managed manager, right? Either of this case, we cannot skip the due diligence. We still need to follow the companies, see what they do. Are they still, executing well? Are they, like, have a good strategy when it comes to growing the business? All these things, right? Whether it's managed by the children or whether it's managed by outsiders, I think you still need to assess the quality of the management. And if the quality of the management is bad, you still need to divest, right? So that's the thing. The good part about this business is, I would say, let's say technology companies, if the managers is bad, then it's very hard to thrive, right? I would just say one good example is Steve Ballmer, right? So you can see that when Microsoft was managed by Steve Ballmer, he still want to try out on the smartphone, still want to do something about it, don't want to, pivot to something that is even better, right? So it's like the entire Microsoft company is like struggling until Satya Nadella took over, and then he pivot into like cloud business and mobile. So mobile first, cloud first, right? That's the new directions, right? And the companies actually thrive, right, with Azure and so on. So I think in technology space, you really need the best manager. If you get a bad one, right, then it's like gone already. Whereas come back to business like LVMH or RMS, I would say just the network effects, right? The network effect, what I mean is that, people will buy LV because it is LV. Okay, they can screw up when it comes to the management of the business, but as long as they carry the name, right, they even if they are dying, they will do a very, very slow death now. So just because of the name, because of the network effects, because if I buy a LV bag, right, people know LV. I can buy another handbag that is like 2x more expensive than LV, and other people cannot, like most people don't recognize the brands, right? So this is the strength of like all this, like the brand. That's why it's a moat, right? So I will say, relatively speaking, when it comes to the quality of management, it is not as important as technology company, but still you need to assess because I would say some manager, when they are bad, they are super, super bad, and they still manage to screw up the business. But I would say, if you just, as long as you track their revenue and income statement, if the business is struggling, at least you can see the sign. It's not that difficult. And from there, you still need to assess their growth strategy, their their business strategy and so on, still need to keep an eye on all these different angles now. Yeah, that's my take on this. It's just that for LV, the other good thing which I mentioned, like the ETF nature, is that actually they don't compete with other brands, because most of other brands, right, in the luxury space, it's all under their group anyway. So you are already buying like a S&P 500 of the luxury business, right? Basically, you are betting on the luxury business. So I think that's more like a sector bet rather than a single company bet. So I think that take away some risk, some individual company risk away already because of the diversifications. But another thing to mention is that I think LV, they've been doing very well in the past 2 to 3 years, also because of, Chinese market, right? So there are all these, China riches, they are buying all this handbag and so on. So probably they are, spend a lot on this. Whether they are able to continue this kind of spending or not, to me is a question mark. And if suddenly they are not able to spend on this sector, or say, for example, if China government do more like a stricter or tighter capital control, would that hit their business or not? I think these are some of the risk factor that you might want to assess. And I just voice up what's on my mind. I don't have insight on a lot of insight on this area, but something to consider.
I have a different approach. I think that LV is kind of like, is very similar to like Mattel, Hasbro, these kind of things, and also very similar to restaurants in terms of the is largely based on demographics. That means one of the reasons why like you can see LVMH has so many different brands under it is because it's trying to capture these demographics as they change. Because there is no, particularly for luxury brands, right? There's no particular luxury brand that is like immune to demographic change. And it could be something very simple, like some kind of stupid TikTok trend that made a brand popular or a brand not popular, that kind of things. And then it also could be that sometimes maybe there are like some newer demographics that are priced out, or they think your product is not not their kind of thing, that kind of things. So it is, if you want to know exactly whether they have that kind of branding power to last forever, right? Not as the company, but as the brand, then you have to be in tune with the fashion trends and be in tune with the social media trends to see which brands are doing better over time. That kind of sentiment analysis. But if you're talking about the company as a whole, then because it's so diversified, it's harder to judge. Yeah. So then but one thing that is guaranteed for sure is that there will always be a luxury brand that is rising, and there will be a luxury brand that is falling. So then you look at the different companies to see whether like a particular company is having most of these rising ones and another one is having most of these like falling ones and are not researching or doing anything new, and their revenues are not justifying that kind of things. Because the people always want to differentiate themselves when they buy these luxury products. And if everyone just buys LVMH, then there's no longer any differentiation. You will start to see some other people buy some other brands to like say, hey, I'm not like all these other LVMH buyers, all these other LV bag buyers. I'm a whatever Hermes bag buyers, but Hermes is also like somewhat related to LV, that kind of things. That there will be this kind of things, and you have to see where the trend goes. Yeah. It's just like also like restaurants also, because at some point you see that McDonald's is like good, then 10 years later, 20 years later, people think that McDonald's is like the bottom tier fast food restaurant, that kind of thing. So yeah, you have to look at the trends and see, and then also see whether the management the management themselves, they're aware that this kind of branding will fade over time, and is why they also spend so much money on advertising or like trying to maintaining their brand power, like Coke try to maintain their brand power, Pepsi. Largely, they are the same product, and they have been the same product for over the past 60, 70 years. They didn't really change, but yet they will still spend money on branding and sometimes release one or two new flavors that there is like flavor of the month or something like that kind of thing. I don't think they really make any money off of that, but it's just to make themselves relevant and in the spotlight. That there's some news article say we release like some Coke lemon thing or everything like that.
I think all this advertisement is just business as usual for them. So they've been doing this for years, right? So they just continue to do that. But in terms of the spending, I think companies like LVMH, they spend a lot on acquisitions also. So if you look at the chart that I'm showing here, right, I don't think this is like from the start, they are already like this, right? I think they do know about like all these like newer brands that become new trending one, and then there's the older one that's die out, right? But what happened is that what they can do is just they continue to acquire all these companies now. So I think that's the way their strategy, which I think work. And good for the investor as well. Like you don't really need to do a lot of like due diligence to buy the individual brands, right? You can see like all this name. I actually can't recognize most of them, but those who are into luxury, they can recognize all these names, right? So if you can recognize all these names, then what they do is just that it's all under LVMH. So when you are buying this company, you know what's your exposures. So again, I think this one, there are people who like the dynamics of luxury goods sector. It's just that for me, I don't have exposures. So just FYI. Okay, last questions. Which criteria do you use to stop DCAing? I would say DCA means just DCA dollar cost averaging, right? Just continue to buy. Later after post production, I will just add my screenshot to show the end hours. I can show you. I still continue to DCA in end hours. It's just that my own portfolio, I say I have like lower down my DCA, but I'm still buying. So I don't want to say just because market already rallied, so I just like continue stop the entire DCA. That's not my plan. Still continue to invest. But of course, how much to invest? Sometimes my DCA is not like really a DCA. It's more like consistently acquiring shares over time. How much to acquire? It really depends on other factors as well, right? It depends on how much I can save during the month and so on. Like previously, I spent quite a huge amount of money like buying flight tickets for the vacation and so on. Suddenly not enough money to invest also. There's some liquidity planning on my side as well. So all this need to be, there's some level that I can adjust for my own personal investment. But for the end hours one, that one is this every month, just constant deductions of money. That one's still ongoing. So I would just say every month I'm still investing. So I haven't been stopping DCA. It's just that in terms of amount, sometimes you can like tweak it higher or lower a bit. I'm not like very religious about it. So if I have less money, what I do, I just invest less, right? Not a things to say. Okay, it's not a market timing, basically. So that's my take on my comment on these questions. I don't think this question is relevant to others because I guess this is specific to me. Okay, I think that's all from my side, and then all the questions we already clear. Anything to share from YCX, Maximus, or anyone else? Do you have any interesting topic, any things that you want to ask, or any comment, anything to share? All right. If no, then we close the sessions. Thank you so much to all who are listening live here, and also to YCX and Maximus. I know two of you have been very helpful when it comes to help moderating the group and also sharing your insights. Those are very helpful. 100% appreciate that. Thank you so much for all. Let's close the session. See you. Bye bye.